Alright, in this video I'm going to talk about how the Canadian housing bubble is going to burst. So in our last video we talked about how the bubble built up and why homes are overvalued. Now we're going to talk about how it's going to all implode upon itself. Let's start with the basics, alright? Once homes get overvalued, overpriced, people generally know that these prices are too high and they stop buying here. And they might move the bubble into other cities or even into the suburbs around the city. So that's catalyst one. People generally know that the houses are too expensive. If you see a rotting, dilapidated house selling for $500,000, you probably have a good idea of whether that city is in a housing bubble or not. Now, that's the overpriced, the overbought situation, and that often occurs in tandem with an overbuilding situation. The overbuilding situation is a natural effect of home prices rising. If you are a home builder, you will want to build your home in a place where homes are appreciating in value. But that occurs after the homes have begun to appreciate. So eventually home builders are going to get in a little late because it takes time to get the building permits to actually build the house and then to sell it. So there's a lag between building. There's a lag that follows the overbought situation, and that's overbuilding. And what happens there is after you've reached your peak in prices where people aren't willing to pay more for a house, well, you've got all these new houses that are now set up, and usually that overbuilding doesn't slow down until the market has begun to decline. So this overbuilding situation brings in an increase in supply. And as you know, supply increases drive down prices. Now if prices are being driven down, you get panic selling. You get people who recognize the bubble is about to burst and they sell their houses as quickly as they can. Now if a lot of people are selling at one time, the idea is much like in the stock market. All this selling drives down prices. You're looking to sell, and if you're looking to sell because of fear, you're looking to sell quickly. That means you're willing to accept a lower price than you otherwise would have if you had more time. So that's why bubbles, housing bubbles especially, burst so quickly. People are panic selling. Now the panic selling is on part of investors, and as you know, not all homes are for investments. We talked about in the last video, there's a lot of for investments in Vancouver, but there's also a lot of homeowners who are getting loans that they really can't afford in Vancouver. That's the second catalyst of the housing market crash. So we talked about MICs in the last video, how they give out loans to people who can't afford to repay their mortgages. Eventually, what's going to happen is one of two situations, alright? One of two situations is going to drive homeowners out of their homes. It's going to drive homeowners either to default or to sell, alright? The first situation is rising interest rates, which would increase mortgages. Interest rates and bonds are tied to mortgage prices. If they go up, then mortgages go up, and the people who had planned on paying, let's say, $1,000 a month on mortgages realize they have to pay more. They might not be able to afford it, they might default, or they might just say, this is not worth the house I'm buying, I'm going to just default, I'm going to sell it off. Fuck it. Right? So, you've got people who can't afford the loans in an economy that's going downward. Now, the other catalyst, and this is the more probable of these two catalysts, right? The first one is rising interest rates, making mortgages more expensive. And the second one is simply the inability to pay off the mortgages due to poor economic situation. As you know, Canada is a economy that's built on commodities. With commodities being in the bear market at the moment, Canada's economy is not so great, other than real estate. Now, let's imagine we're in Alberta, and some huge oil companies simply can't afford simply go bankrupt because of the oil prices. If that happens, lots of people in this one city, lots of homeowners in this one city will lose their jobs. If they lose their jobs, clearly they can't repay their homes. They will default. This whole group of people will default due to poor economic situation, a la the oil industry and oil companies going bankrupt. Once all those people default, it drives the housing prices down. So, let's say I'm in Alberta, but I'm in the real estate market. I'm making money above and beyond what laborers do. So I could actually afford my mortgage on my home. But now that all of these other people have lost their jobs and they're all defaulting on their homes, they're driving all the housing prices down in Alberta, including my house. So it would be smart of me to simply not pay. Default on my home and reinvest whatever. It's just a logical decision. I thought my home was going to be worth $2 million. But now that this is happening, it's going to cut the price down in half. I'm not going to keep paying the same mortgage when the asset that I'm getting is now half price. So I'm going to default too. What happens is you get a bunch of people defaulting all at once because of the bottom tier, because of the people least likely to pay off their mortgages defaulting. That's what happened in 2008 as well. So look at the MICs. Again, the MICs give out loans to people who can't afford loans. These people can't pay them back. This is almost unrelated to the economy because in the first place these people shouldn't have been taking out mortgages. So it's the same thing happening not just because of economic factors but because of the MICs as well. In the end what you get is a bunch of people at the lower echelons of the social economic rung that cannot pay their mortgages, they default. That drives housing prices down in addition to the oversupply, in addition to the fact that foreign investors who want to buy homes in Canada have probably already done so, so the demand is probably lower now than it was before. You've got all of these catalysts adding to a bubble bursting, which is literally housing prices dropping very, very quickly. When people default, the MICs will lose money. Lots of them will go bankrupt. The banks will lose money. They might have to be bailed out, like in 2008 in the US. Overall, it's not a pretty situation for homeowners, for people investing in real estate, or for the big banks and MICs in Canada. It was a nice ride, but it's probably over. So if you're invested in real estate in Canada, find a way to hedge or get out. I know getting out is not easy, and you're probably not going to get out just based on a single YouTube video, but at least consider it, look into the facts, realize that Canadians are very overbought in the real estate market, especially big cities. If you're in a rural area, you're probably okay. If you're in a suburb of like a tier 2 city, you're probably okay. But if you're in Vancouver, Toronto, or Alberta, or if you're in British Columbia or Ontario, if you're in any of those big real estate markets, you're probably going to be hurting pretty soon if you're holding on to real estate of any type, because all the prices will be driven down by this collection of catalysts. That's it. If this was helpful in explaining this two-part series with an explanation of the bubble building up and the bubble bursting, the latter has yet to happen. If this was helpful, please click like and subscribe for more videos. But also tell me what you would like to see. This video, after all, was a request. So if you leave a request in the comment section, I will make sure to get your video done.